Joining us now, Carol Schleif, BMO, private wealth chief market strategist. Hey, Carol, it's good to see you. The way that the Journal, I like summarized what Powell told lawmakers yesterday. It's kind of indicative of, I think, what we're talking about. He said, yeah, recent economic data would have likely justified some cuts, good cuts, I think, because of inflation, not necessarily because of bad reasons for weakness. However, higher tariffs might derail the Fed's fight against inflation. So it's all about whether you believe, and not everyone does, it's whether you believe that tariffs could sort of be a self-replicating problem instead of a one-shot deal. Waller says he's not even sure that it happens the first time, much less that it feeds into something bigger. How do you feel? Do we need to be wary of tariffs?
I think that they've gotten pretty overblown, and it's important to remember that 70% of our economy is services-based, and these tariffs so far are just on goods. And granted, even the goods producers, it may filter back through, but it's really unknown. And Chair Powell did a great job at last week's press conference from the FOMC, laying out at this point, we don't know who's going to pay it, if anyone's going to pay it, how it's going to filter through the system. And that said, the economic data they feel gives the in aggregate they feel, even though there's some dissension on the committee right now, they feel that they have enough room to be able to be patient and let this play out. And to Chair Powell's comments, too, both yesterday and last week, they think they'll get more data and a better read as we come into the summer. And we're right around the corners from earnings season, so hopefully we'll hear more from companies about how those tariffs that are already out there are, how they're dealing with those.
Right. Well, what do you think the neutral rate is? That was another thing. There's a lot of dissension on that, too. But if it's 3%, we are obviously too high. The only thing that I think could come back to burn Chair Powell is that if your eye was on inflation because of how you got burnt last time, and you really were sort of biased that way because of what happened, and you're missing the bigger elephant in the room, which is a possible slowdown from the uncertainty, then you're going to be late. You're going to be late, and you're just going to be cutting after there's already a problem. But I guess we haven't seen necessarily any signs that there is weakness at this point. Maybe that's not something to worry about. Maybe neither thing is something to worry about.
I think that's the obsession with the Fed actually distracts us from looking at the economic data. And the economic data has been pretty solid. Granted, the inflation data, the CPI and PPI, were much tamer than people had expected. Yet economic growth has been sturdier than people expected too. And we just haven't seen broad translation through of tariffs yet. And granted, there's been lots of fits and starts with the tariffs. Some are still out there, more are coming, and I think that's the piece. But the obsession with when the Fed's going to cut, whether it's July or September, we still think directionally the Fed is going to cut at some point this year, whether it's July or September. Not sure why the markets are leaning into a cut so much, because keep in mind, when the Fed was cutting before, it didn't do anything to help. It actually ended up harming those intermediate and longer term rates. And one of the other things that the bond market wants to watch is what happens with the one big beautiful bill and what the price tag is on it, because that will impact those longer rates probably more than the Fed cutting the short rates.
Maybe. I don't know. We had 4 years of stuff that should have scared the bejesus out of the bond market, and it didn't. I don't know if this is anything worse than what we already
Agreed.
What we already saw. Wouldn't it be great if the stagflation worries, if we didn't have stag or inflation, and that we were wrong, all those concerns, and we had a low inflation, solid growth environment? But if we do have that, and if it continues, then you got to give credit to Jay Powell, I think, and the Fed.
Well, there's that piece of it, but the equity markets are definitely leaning into the fact they suspect growth is going to be higher, inflation is going to be more containable. And the other thing we can't forget is how resilient our businesses have been. They've been living with tariffs since 2018. They had pandemic in there. Everyone talks about clarity, but our businesses really haven't had clarity for close to decade, and yet they figured out how to navigate around it. And they're sitting there waiting. You're seeing it in the IPO markets. You're seeing it in the M&A markets that there are deals wanting to be done. And if the government in particular can change the narrative to focus on the tax-friendly aspects of the One Big Beautiful Bill that are favorable to expansion here and M&A plans and R&D, and focus as well on some of the growth-oriented aspects of removing regulation, speeding up permitting, you could easily unleash a cycle that supports a little bit higher growth in a less inflationary way, especially as we roll out technology and artificial intelligence and robotics and all the other things that go along.
Maybe we don't yet fully appreciate, like with the internet, how AI is really going. So many things it's going to affect, and maybe it is really bullish. But maybe we should be buying lounge chairs and companies that make those little fans.
Well, definitely with the
Netflix and Netflix, because we're all going to be
Netflix and chilling.
Yeah, we're all going to be watching TV, sitting outside, and with in the lounge. Or maybe none of us are going to be working at that point. I don't know.
Well, some of us will still be working.